I think I'm up next. I'm Tim Vanoy with One America. So I'll take it from there unless I made a mistake. But hopefully you're seeing the screen as we're going through this presentation. I want to say thanks to the folks there at NAIFA with respect to extending the offer today to make this presentation. Great panelists with respect to the conversation as we're going through. So with that, let's go ahead and get started. Just a little bit more about the information, how to contact us here at One America. Mention again, Tim Vanoy, Regional Account Director. You'll see my email address there. We have a website. It's assetbasedltc.com. It's not password protected. So if you do need, want to look at some of our information, cost of care calculators, quick quote systems, brochures, information for client-facing, producer-facing, that's all there. And then we have our sales desk there in Indianapolis, the 844-833-5520, or reach out to any of the BGA back offices that you work with to access our products. So with that, I'm going to go ahead and get started. I'll share this at the end of the conversation as well as a follow-up. So I want to start with this whole thing about long-term care. It says, don't be scared with long-term care. So I thought, why not start with that? When I was doing presentations, if we were in an audience today, what's the first thing that you thought of when you hear the words long-term care? Now, I know everybody can't raise their hand or they can't shout it out, but I will tell you that from my experience, we hear the words long-term care equals nursing home. And so when you start thinking about your clients, when you start walking down the path with respect to the conversation with your customers, think that if you say long-term care, they're also thinking about nursing home. And the follow-up to that is, how many in this audience is interested about going to the nursing home, and nobody raises their hand? So think about words matter. And I like the way that the title up there, limited and extended care planning, because I want you to get rid of the words long-term care and start using that conversation piece of extended care planning. It goes with everything else you do every day. You do retirement planning, life insurance planning, income planning, estate planning, legacy, business succession planning. Why not have the extended care planning conversation as well? So that's the opportunity I think we have there. Take out the long-term care, introduce the extended care conversation as it relates to that. So one of the things we did about a year ago, we launched some information off of a study that we did with some consumers. We pulled a group of consumers and we asked them, what do they believe what do they see or what do they understand as consumer, the primary purpose of long-term care insurance? What is it supposed to do? And 52% of the respondents said, and this is the number one response, remove the burden from my family. I think that's huge, right? So once again, if you're thinking about having these conversations with your customer, knowing in the back of the mind, they may never say that, but there's the burden that they want to get off the table. In fact, when I've had these conversations with clients, I may ask them, what's caused you to start thinking about planning? And they'll come back and say, well, we don't want to be a burden to the kids. More times than not, somebody's having that front row seat to a condition, an illness with mom and dad. I think Tom mentioned about that earlier. He saw that with his mom. So that's kind of the buyers of what we're looking for. They have to have a personal experience in some respects. And now they're going, holy cow, that was a train wreck. And now I don't want to be that burden to my family. 46% of those folks said there's a financial impact. I call it impoverishment. We don't want to put mom or dad in the poorhouse. So there's the financial impact. It's the income, the lifestyle. I want to maintain that lifestyle. 37% said they want to receive adequate care. That's an interesting one in itself, because if you start thinking about how do I access care, most people want to receive care in their home if possible. And if you start thinking about the families are the ones that will jump in to help, they just can't do it 24/7. Mom will help, but she can't be there 24/7, 365. The old story is the healthy caregiver becomes chronically ill themselves. So what we're trying to do is thinking about what does the purpose of long-term care, what does it do? And then how can we kind of formulate our solutions? A lot of great solutions in the marketplace. Just know that the families, or they don't want to be a burden to the family. They want to remove that financial impact, and they want to receive care where they would like to have that. So with that, we asked them who or what will pay for care. And this is interesting as well. So I started thinking about this. 63% said we're going to take it out of personal savings. 53% said Medicare. We know there's some limitations with Medicare, but and so we got some education to do, some training, some helping the consumer understand that Medicare may not be the right solution. And then we got Medicaid, right? There's a 5-year look back, there's the spend down. Medicaid's free for those that don't have anything, but it becomes quite expensive to get on Medicaid. And of course, with Medicaid, I'm experiencing that right now with my sister. My dad's on a Medicaid spend down. We don't choose where he goes. The caseworker decides what his needs are and what facility he will go into. And 12% haven't thought about it. They don't know how they would be paid for. And I think back to the prior slide, it says, what does long-term care do? It removes the burden, but it also is the financial impact. And if we start looking about who would pay for it, it's the personal savings. So I think the opportunity of having the conversation about insurance and what that looks like, this is a great opportunity to do that. Let's talk about different types of awarenesses of different types of coverage in the marketplace. This group that we polled, 70% said they were familiar with what I call the traditional health-based long-term care insurance. Great solutions. 39% were aware of what we call hybrid products. And about 1 in 4, 24% said hybrid annuity plans. So I think there's a great, once again, whether you sell the traditional, the hybrid, the annuity, the life, whatever, there's a whole bunch of people out there that don't know much about our products. And that's great opportunity for all of us on the call today. So I think that's another place for us to think about how we would go about the conversation out there, just trying to put that together from a planning perspective. When we asked them about going a little bit deeper into the hybrid plans, and we threw a whole bunch of different features and benefits of what hybrid plans provide, 94% of those folks said we really like guaranteed premiums. That's a feature within the hybrid plan category. Tax-free benefits. All the policies provide tax-free benefits, but we forget to, I should say, we talk about it every day. We assume that everybody else knows this. Just realize that the consumer does not know this at all, and talk to them about how the tax-free benefits would be available for them. 84% said they'd like to pass something or unused benefits to their heirs. And last, the number 4 top feature of a hybrid is the flexibility of premiums. We'll get into that in a couple case designs as we look through the time that we have together. So that's if you're thinking about from a hybrid plan, and it's pretty much generic across the table, regardless of One America or any of my peers in the space. So great opportunities there. I will also tell you from a planning perspective, the best policy is the one that's in force at the time that it's needed. I've never had a beneficiary that I delivered a check to. First and foremost, they had to have the policy in force, so the policy had to be being paid or paid up, whatever it was. But they didn't really care if it was a whole life or term or a UL or a VUL or whatever it was. They were just glad that I was bringing a check. So don't get caught up too much into that. Just think about, I need to do the right thing for my client, and all things will happen. So from a hybrid life and or annuity design, we will start with the base policy. That's that dark blue box there you see on your screen. And below that, from a funding perspective within One America, at last count, I think I have 18 different ways that somebody can slice and dice the premium options. That goes back to what they like as far as the characteristics, the premium flexibility. Some of the examples could be a single premium product. We have a unique way to do qualified IRA funds. You can do an annual pay and you can do limited pays. And of course, we can accept 1035 exchanges for the life. So there's lots of great funding options with respect to when you're starting to work with the design for the life. Funding options for our annuity, the Pension Protection Act annuity. We have 3 different flavors of that. And normally that money comes from what we call the 1035 exchanges from old non-qualified annuities, or it's coming in as cash, right? So that's the opportunity there. And we'll have a case study of what that looks like. So that's the base policy, base life insurance policy, base annuity policy. And then we have this kind of that light blue. We call it our continuation of benefits rider. If you were to call one of our internals, they would be talking about the COB rider. That's the acronym we use. But the continuation of benefits rider can be limited or unlimited lifetime benefits. So we can design either option for your client and each of them have a different price, and I'll get into that here in a couple of seconds with an example. That continuation of benefits rider is filed as a 7702B for the technical people out there. Basically what that says is you can deduct those premiums. That's what that tells us. It's a tax qualified long-term care plan, just like the traditional health base. So there is some tax deductibility on the rider. Can't deduct the life premium or the annuity premium, but I can deduct for sure based upon either a business or my Schedule A if you wanted to go down that path. But there is premium deductibility and eligibility, or it can be paid out of an HSA. I think Tom mentioned about that earlier as well. So some different premium options that can be used there. Within the hybrid life, I didn't want to talk a lot about how all the different moving parts. I just want to pick one concept here within the One America suite. We're doing a joint life. That's kind of a flagship. We've been doing joint life for a number of years. We got a female 60, a male 61, and I call it the good, better, best. When I was an advisor and I was meeting with clients, I'd always give them 3 options, and I kind of summarized everything as a good, better, best. So as I move left to right, I'm going to get more features. I'm going to gain more benefits or something like that. So the first thing, these are all annual pays. So you're going to see the premiums there at the top. And I put in their guarantee. This would be a quick summary that I would give the client so that they know that those premiums are guaranteed. The 358, the 436, or the 570. That's a monthly premium. Then we get into the death benefit that I get something back for my heirs if I never need this. This becomes a last to die policy or a second to die policy because we're insuring 2 individuals. But they're guaranteed $100,000 out of the policy, whether it's $4,000 a month checks or it's a lump sum at death at the last. Doesn't matter. They're going to be guaranteed that $100,000 or the 133 in the last 2 examples. The long-term care benefits are tax-free at $4,000 each. And the best way to show this is I draw a bucket with a couple spigots and I put a $4,000 under one spigot, $4,000 on the other side for the other spouse. And I just say that you got a pool of $200,000 and it's going to be drained. If one goes unclaimed, you have the whole 50 months. That's a shared bucket. If they're both unclaimed, basically the bucket drains twice as fast, so you got 25 months apiece. We can add inflation, many inflation options. That's optional. All of our recurring premiums include a full waiver of premiums, so that $358 premium disappears when one goes unclaimed. And of course, our built-in claims concierge team there in Indianapolis. So that's the good plan. We move over to the middle option, the better plan. All we've done is made the bigger pool of money, a little bit more life insurance. It just kind of gets back to what's kind of keeping them up at night. Are they worried about average care, long-term care, 12-year dementia, or Parkinson's, or something like that? And then I go into my best option and give them that option. What we've done there is I've included that lifetime unlimited, $4,000 for the rest of your life. It's a check you'll never outlive. Maybe that's what's keeping them up at night. So once again, I've given them some nice options as we go across left to right. And that's a great way to kind of get the client engaged in what parts do they like. And normally they'll gravitate to one of the 3. And then it's just our opportunity to kind of put together the application and get everything done. So that's a quick summary of the hybrid life plan. I want to kind of jump over to the other side here and talk about annuities for a second. I would assume, and I'm making an assumption here, that there's a lot of, there's a lot of old non-qualified money out there in annuities. And if care was ever needed, which would be the best option? So on the left-hand side there, we got an old annuity with some gains. Think back in your book of business. I guarantee you probably have people in your book of business that have bought an annuity. They haven't touched it. They've never touched it. It's rainy day money. And if you were to ask them the magical question, which is, what would cause you to spend it? They'd say, we're never going to spend it unless we're in a nursing home. And then all bells and whistles should be going off because there's a more tax efficient way. Because that old annuity that's always been focused on accumulation and tax deferral. Now we got a problem when they start taking that money out. The first thing is federal taxes. Then we got state taxes. And then we get that thing called provisional income, which is how much of my Social Security is going to be taxed. And if you're really successful, you got that Medicare Part B and D surcharges, IRMA tax. It's the surcharge. So for every dollar I take out, I'm not going to keep a dollar. And the last thing that's part of that old annuity with gain is the long-term care capital gains rate. We don't pay long-term capital gains on the distribution, but the long-term care capital gains rate is tied to one's income. So you start showing about all the taxes that they're going to have to go through, keeping it where it's at. Maybe if I 1035 it over into a tax or a Pension Protection Act qualified annuity, still has accumulation, but the focus now is distribution or protection. So I can get that money out income tax free. That's what Congress gave us. Congress said we can get that money out income tax free if it's needed for care, 2 of 6 ADLs or cognitive impairment. What a great way to have all those tax deferred, all that tax deferred growth. And if they do need care, I can get it out and I can get the dollar back out tax free. So that's a great planning perspective, especially for older clients, 75, 80, 85. We'll go up to age 87 if needed. So we've got a long runway with older clients that are now starting to think about their extended care plan. Here's the Annuity Care 2. This is one of the 3 options we have. We have 2 fixed annuities. This is one of the 2 fixed. We also have an index product. This is a single female. She's widowed. She had a old annuity that she's had. She put in $50,000 some years ago. It's now grown to 100. So she has $50,000 in basis, $50,000 in gain, a total of $100,000. She's widowed, so she's basically going, I don't want to be a burden to my kids. I'm thinking about the financial ramifications. If I do need care, what's going to happen? Where would I might receive my care? How would I pay for it? So if she moves that 1035, that 100,000 into the Annuity Care 2, that base contract is going to be the 100,000, that darker blue. We're going to basically use her money for the first 24 months. That's going to be exhausting the base contract. She gets $4,200 a month, income tax free. Once we've used up that bucket of money, we go into the light blue box there. It's another 72 months, $4,200. So there's a nice opportunity, tax-free benefits. She puts in $1, she gets $4 back day one. That's huge. Tax-free, by the way. We got rid of that $50,000 gain. The kids didn't have to. So the good news is we can eliminate the gain, and I've taken a great leverage. Put in $1, I get $4 back. That's just one example of the leverage you get within the hybrid annuity products, and a little bit less underwriting. So there's some opportunities there. Maybe I think Tom mentioned the pre-screens. Those are great. We do a pre-screen with our company, and the underwriters will kind of give us, I call it the green, yellow, red. Red, don't go any further. We can't take that. Green, let's move forward with what you gave us. Yellow, let's be careful. We probably need to know a little bit more, and we can give you some guidance there as well. So great opportunities as it relates to that. As I start to wrap up here, a study that was done by John Hancock a couple, probably 8 or 9 years ago, and it was confirmed or reconfirmed or validated again with our research, is that clients want their advisors to start the conversation. Those that are on the call today, your clients are waiting for you to start the conversation. And I'm going to tell you that if you don't have that conversation, just assume that another advisor is. It's not that it's not going to happen. They will seek somebody else. So why not? Why not have that conversation? And here at One America, we got some great ways to help and partner with you to do that. First and foremost, the One America Sells Stories. We launched a couple months ago with the friends at Insight, scripts and a playbook. It's a story to walk somebody through. Why should I have this extended care planning conversation? The impact to the family, impact to income, retirement planning. What bucket is the money going to come from? How would I pay for it? We provide you the scripts. I can teach that probably in about 20 minutes, and you can go out and make a nice presentation to a customer yet this afternoon. So we got scripts and playbooks integrated within our illustration, so it's all dynamic. We have email campaigns. If you want to do an email campaign, we got opportunities for you to do that. Educational workshops. I get asked probably once a week, hey, Tim, we're looking for a educational workshop to do something down at the community center. We want to do something in our community. And so educational workshops work great. And we have 3 turnkey programs. We got the invites. We got the workbooks. We got the presentation for you if you want to take advantage of that and do that in your community. And last but not least, you got mailers. Drop something in the mail. The key with any of those things is you got to follow up. We got to follow up and make sure. I mean, we can send out all that stuff. If you're expecting them to call you back, don't send it. But I would tell you, if you send something out and make a phone call, ask them back in to talk about their extended care plan, I guarantee you're going to have some great success. So with that, I want to say thanks again to the folks at NAIFA with the opportunity to present today. There's the contact information on how to reach us here at One America. Great partner with NAIFA as well. So if there's anything else that you need from us, there's a couple different ways. And once again, have a great Halloween. And one thing I'm going to leave you, one last thing. And I know we're just on the cusp of November, and then we got Thanksgiving. The day after a holiday, so the Monday and Tuesday after Thanksgiving, our claims intake people, the phones just go off the show. It's just ringing nonstop on the claims, because the family all got together and they saw what's going on with mom and dad. And they said, this is unacceptable. We got to get care in here. We need help. So when you're starting to have those conversations with your clients, knowing the good you're going to do and help those clients and those families so that they have a company to call to basically help out when mom and dad need some help. So with that, have a great early Thanksgiving as well. Appreciate everybody's business and the time today. And I'm going to